Today I'm going to show you why I use a holding company structure. If you have multiple businesses and you're moving profits from one into investments in another, then you could be making a huge mistake. You might be paying lots in tax if you pay yourself dividends by moving the money up into your name and then loaning it back down into another company. And even worse, if you're loaning money from company A into company B, then you could be putting those companies both at risk. In this video, I'm going to simply break down why a holding company structure is the smart way to manage your businesses, especially if you have multiple ones together. A holding company structure is an incredibly efficient way of moving money up from one company and the profits up into the holding company to either keep there for another day when you're ready to draw a dividend or a salary, and you can then safely loan it back down into another company that could be, for example, in property investment. Hey guys, welcome back to the channel. If you're new here, my name's Matt. I work for a bank by day, I invest in property on the side, and on this channel we explore all things money, finance and property investing to help people lead a more financially savvy life. If you haven't already, then please consider subscribing to the channel to help finesse your financial wisdom. First things first, I'm not an accountant or an accredited expert, so please speak to your accountant regarding your own individual tax situation, because anything that I say in this video could be wrong and rules may change in the future, so just be smart about it. Firstly, we're going to explore the different ways of moving money from company A into company B and the risks and the problems associated with that if you don't have a holding company in place. Okay, so firstly, let's imagine you have two companies and they are both 100% owned by you. Now, if you move the money up and then down again, almost like a bit of a triangle, you'd first move the money out of company A by using dividends. So you use those dividends, you send them up into your name. But the problem is here, by the time it reaches you, you'll have to go through personal tax, national insurance, potentially student loan as well. So you've lost almost half of it, especially if you're a higher rate taxpayer. And then you loan the money from you down into the company safely so that then the company B owes you the money in the future as a director's loan. Now this is okay, it works, but you've lost half of your money. Imagine if you had £20,000, you moved it up into your name, you had tax, national insurance, student loan and everything else. You then have about £10,000 left and then you loan that into the company, you've just lost half your money. So another way of doing this is side to side. This is where you don't pay yourself any money directly and instead you loan the money from company A into company B, which is your investment company. Now this can work, and the benefit of this is that you can move that full £20,000 from company A into company B without losing any of it to tax and national insurance and anything else if you paid yourself first. However, this could put both companies at very high risk to each other. So let's say that you had a cash flow business and company A was doing really well and that was your bread and butter that brings in the money every single month. Now, if you're investing the profits, the retained profits from that company into company B for investments, it works and it's tax-free. However, if your investment company failed, bearing in mind that any type of investment comes with risk, especially in property, if something went wrong with a property deal or the market crashed or you had dodgy builders and the project went over and it basically meant that you had to default the company and bring the creditors in by liquidating, it means that the creditors, when they come after your company that you're closing down, because you have loaned money directly from company A to company B and they're both owned by you, it means that the creditors can come after your original company A because you loaned money between the two. And this is what people don't realize. So yes, it's tax-free, but it puts both companies at risk and creditors can come after any of them. Another thing to think about is if you run or own a company with other directors. So let's say you have company C and there are 3 or 4 directors in that company. Now everything's going well, there's good cash flow in that particular business, and the only problem is here that when the directors want to draw dividends to pay themselves, let's say you've already got a very healthy cash flow and you're a higher rate taxpayer from company A. The problem is you then have to also take a dividend along with everyone else in company C. They'll take the dividend, it goes up to you personally, and again there you've lost half of it through tax, national insurance, student loan, etc. So now we're going to explore the difference in those exact same scenarios if you have a holding company in place. A holding company is just another limited company that you own 100%, and then any other companies underneath that are owned 100% by the holding company. Any lower down companies that the holdco owns are essentially called subsidiaries, and lots of companies use these that you know every single day and buy products from. So back to the original example, let's have a look at the up and down strategy first of having a holding company structure. So let's say that company A makes a decent amount of profit and you've got £20,000 to move somewhere or invest into an asset like property. So company A then announces dividends and they can move those dividends up to the holding company completely tax-free. So let's say that company A has made around £20,000 profit after paying things like corporation tax. You can move that £20,000 up into the holding company completely tax-free. And then you can safely loan it back down into company B to invest in things like property. Whereas before, in your own name, if you would have done this up and down, you would have lost half of it to tax, national insurance and student loan. The great thing is here that I don't really need to explain in detail if you loan money side to side, because we already know that loaning money from company A into company B puts the companies at risk, because if one defaulted or there was a problem and it needed to close, then the creditors would come after the other business as well. Whereas here, by moving the money up into the holdco and down into another company, it means that each subsidiary company is protected legally and it's its own separate legal entity. This means that by paying dividends up and then loaning it back down, if the investment company failed or there was a problem or you had a joint venture that went wrong, then that means that all your other companies owned by the holdco are protected and safe, and creditors cannot come after them. This also works really well if you have a company with other people. So let's say you have 3 companies. Company A is your cash flow one, company B is the one that you invest in property, and then company C you own with other people that also generates a decent amount of cash flow and profit. Now in company C, let's say the directors are ready to take dividends and you're already a high rate taxpayer because of company A and the dividends and profits that you take from that company. Now in company C, when they take the dividends, you will get all of that tax-free, because again, you're moving money through dividends from a limited company to a limited company. So rather than you personally having a share in company C, it's your holding company that holds the share instead. This way you can then spread out costs over many years and utilize as much tax benefit as possible, meaning if I had £80,000 in the holding company, I could spread that out over 2 years and pay myself £40,000 in 1 year and £40,000 in another year, therefore staying as a basic rate taxpayer rather than a higher rate taxpayer, and thus paying less tax overall. And lastly, one thing I want to touch on is generational wealth and succession planning. This is another great thing to be thinking about, that as you get older and as life becomes more precious, then if you have children, then they can also become directors of the holding company, and that way when you pass away, all that cash in the business can be retained there rather than being personally in your name, and therefore being subjected to a lot of capital gains tax and inheritance tax by the kids or your spouse. So we've tackled why it's more tax efficient to have a holding company, and also that it's less risky to your other businesses. Are there any cons to having a holding company? Well, I'm not a massive expert on this, and I can only really think of one major con. I'm sure there are probably others, but it's best to speak to an accountant about that. The con of having a holding company means that you're going to be paying a lot more fees overall, so you've got to make sure that you have a good amount of cash flow. So you're going to be paying multiple accountancy fees for up to 3 or 4 companies, because the holding company is another one that you have to look after. You'll also have to pay things like extra bookkeeping fees with Xero or QuickBooks, and then you'll also have extra bank accounts to open, which means extra banking fees on top of it as well. And that's all I'm personally aware of, so it sounds quite biased in this video. I'm sure there are other cons on holding companies, but that's something to explore for you in your own personal situation to speak to an accountant with. I hope you found this useful or shocking and eye-opening if you realise that today you actually have a bit of a non-optimised company structure. So hopefully that was great and useful for you. Thanks for watching. You can check out any other videos just like this one here. Otherwise, thanks for watching, and I'll see you in my next video.